Hey, it's Jeff Timborello. I'm the director of the Southwest Florida RE, and I am here with John Svirsky, one of our valued corporate sponsors. And we're here today to talk about non-traditional financing for real estate investors. How you doing today, John?
Doing good. Before we begin, I want to thank Southwest Florida REIA. It has been a tremendous resource for me, and I've been a proud sponsor for a couple of years now. Really appreciate all you do.
Yeah, we should be doing business together. I think we have the same barber.
Yes.
So tell us about John. How did John get involved in real estate and particularly real estate financing?
Well, I'm a little unusual in this field because I've been doing it since 1979. I started doing commercial real estate financing because
You actually know what the Solomon brothers are.
Yes, I work with them. Actually, I sold a lot of deals to them. And most people know Warren Buffett saved Solomon Brothers the first time. But going ahead, I got into commercial mortgage brokerage for a very simple reason. I didn't have my own money to lend. And it was being a broker was a very convenient way of putting people together. And over the years, I've been through a lot of financial crises, ups and downs. I started in 79, and in 1980, the prime was at 20%, 18 to 20%. And believe it or not, we did a lot of business then because people needed money. So going through the years, I've done high-end residential, which I no longer do, and commercial, depending on the ebbs and flows of the market. Since the last 10 years, since the crash actually, I've been doing mainly commercial. And I found that in today, 2019, 2018, 75% of all bank applications for loans are rejected for commercial loans. That means 75% of borrowers, maybe 50% are worthy borrowers, don't have a home. And there's hard money, the Uncle Vinny's of the world, but now there are a lot of other traditional sources. And I use hedge funds and I use investors and banks. So the rates go anywhere from 6% to 12%, depending on the deal and what you need. And it's a tremendous marketplace. And then also SBA, which I don't do a tremendous amount with, has found a great niche, being that I could fund in 3 to 4 weeks to get a commitment funding within 5 to 6 weeks. Traditionally, SBAs were months and months and terrible hardships. We don't do it that way anymore. And for an example of a deal I just did, a client was buying a truck dealership where he was a tenant for years, and he was buying the property by contract at $2.4 million. He had put $800,000 of his own cash in as a tenant improvement while he was a tenant, not an owner. Most banks and most SBAs would only give them based on 2.4. We were able to lend them based on the 3.2 purchase price plus tenant improvements already paid, and we lent them $2.8 million, start to finish 6 weeks. That's the example of what we can do. Interest rate was 7%, 30-year mortgage. That's what we can do for clients.
Tell us about some recent deals you've done for investors over the last 6 months.
There's a tremendous movement towards, fix and flips have been going on for a long time. It's even harder to find. Many of my clients are buying properties or have properties that they've rented for a while, and we're lending 85, sometimes 90, but mainly 85% of the purchase price, 100% of the refinance price, of the rehabilitation price. Meaning, if a client's buying a property for $500,000, my lenders will lend up to $450,000 towards the purchase, and then 100% of the rehab price. So it's effectively almost a 90 to 92% leverage on a deal. It's 12 to 18 months. Now, if a client has a portfolio, as many Florida REIAs do have, and I've worked with, have a portfolio of many properties, we could do a bulk financing. In other words, they may have rental properties of 10, 20, 30. We could do one blanket loan on everything with individual release clauses. Then it's a fixed rate as opposed to interim loan. Then there's the other thing which I talk about at meetings, where we have one investor who, depending on the amount of money you have in the bank, will lend 5 times that amount as a line of credit. So if you have $1 million in the bank, they'll give you a $5 million line of credit to do new purchases.
Now, do they freeze that money? Is that money essentially frozen as collateral?
I'm not sure what you mean by frozen, but what it is it's a line of credit not charged for until you use it. Every deal when you find a property, they have to approve it, but you've already been approved as the borrower. So now they're only approving the purchase. And you're going in and out. And you can use this every year, it gets renewed.
Okay, cool.
Yeah. So the marketplace right now, where a lot of people are cautious, I'm even doing a deal in Estero right now, or a 16-unit development. Banks are very cautious about new subdevelopments. And in this case, so we were able to get them 65% loan to value. A couple of months ago, it was 75% loan to value. Then last month it went to 70, now it's 65%. So that's telling you about the term of the market right now.
Well, December shook a lot of people up, and I really see December in the stock market as more, everybody knows at some point we have to have a recession. And I think that the traders realign themselves in December to be ready for it. It's going to be interesting if it happens or not, because in 2016, we were 2 years away from a recession. In 2018, we were 2 years away from a recession. At some point, it's got to happen, though. But December to me, when I look at the stock market, because it really not a lot of what was going on truly made sense, other than I know banks, particularly the balance sheets are not strong.
Well, two things. For the people watching this, if you look at a 100-year chart of every decade from 1900 to now, you'll find a 9 out of 12 since 1900 decades, there's been a recessions in years 0, 1, and 2. Somewhere in that period, there's been a recession. It's totally statistical, nothing to do with politics. And you'll find that 7, 8, and 9 are usually very boom years. So It's going to happen. And then all you have to do, and I did this too late, unfortunately, in 2007, 8, read the newspapers. Wall Street Journal every day says, best economy we've ever had in our lives, but we're expecting. They're projecting the fear. So figure the second half of 19. Now's a good time to solidify.
There's a trading principle called the Elliott Wave. I don't know if you've ever heard of it. Robert Prechter. And when I first discovered it in like early 07, I think I got online and bought $300 worth of books. I bought every book they had. And there's a socioeconomic side of the Elliott Wave where they talk about basically what kind of mood the herd is in. And they even correlate, they had a really interesting chart of the horsepower each year of the Corvette going to market in relation to the Dow. And they correlated really well. I mean, and it's, that's really obscure and anecdotal, but they even, those guys chart skirt lengths on the runways, because as the economy gets bad, the skirts get longer. When the economy's good, the skirts go higher. And they even, because I can remember in 08, there was a fashion show, and I don't know how it came on my feed, but they were basically dressed as vagrants. And I think that really, really accentuated what the herd was feeling at the time, that the world was ending and it was never going to get better. And that's the interesting thing, with the cyclical side that you talked about, is that, like in 2008 here, somebody was convincing me, like over coffee, really, really like a hard sell on why we had 20 years worth of condos and how the condo market was never going to recover. And I'm like, at that brief instant, there was it was like 20 years worth of inventory. But as the price came down, they started gobbling it up. And before you know it, we had 4 months inventory, like 2 years later.
Exactly.
And that's kind of the really interesting thing about, people tend to focus on what they feel and what they hear now. And they don't really know that, nothing has changed with human beings since the first biped walked out of the cave. And we just keep repeating it's Groundhog Day. We keep repeating the same things over and over again with a different intensity and a different duration. And there's different variables. But you were spot on that it's pretty much, it always goes the same way.
Well, for RIA investors, usually what Jeff just said, the real point is let us learn and grow from our mistakes. God knows I've made tons of them and still paying back for some of them. But the point is, if we're going into 2019 and 2020, Let's be smart investors, stay away from the herd mentality, and more importantly, go into what's right for what my economic condition is. What am I looking for in 2020 in terms of income return? What am I looking for 2025? And if each individual investor focuses that way and models their portfolio based on what their needs are, not what the herd's needs are, they'll do much better. I'll just put in one last thing. Tony Robbins, everyone knows Tony Robbins, who's been a financial advisor to many of the great Wall Street guys, including Ray Dalio. Ray, at the crash of 2007, I guess it was, 28, and he was paying Tony Robbins $1 million a year for instant callback. And Tony Robbins told him that every time there's a crash like this, within a period of time, whether it's 2 months or 3 months, there's an upward trend again. So I am very careful in my own portfolio where I'm investing, not to buy into the negativity, but also not to have a panacea advice. Go back to the fundamentals. You teach that in class. Go back to the fundamentals. What's your cap rate? What's your return on investment?
Yeah.
What are you going to get for what you're doing? Right now, it's very important, at least for me, if I see a deal that doesn't make sense and a client comes to me looking for financing, I have no problem telling them that the deal doesn't meet the financial criteria and maybe they should look at it. I'd rather say no to a deal that doesn't work for me or for the client than to say yes and just take money.
Yeah, because I owned the mortgage company for a long time, and I can tell you your name's on a deal nowadays even more than back then. And it's really going to reflect on everybody. And I can't tell you, it's something, here's an interesting topic. I owned a mortgage company from 99 to 07. I was in the business from 95 forward. And I really got to watch a lot of really successful investors who use leverage properly to make money. And
Yes.
then I also watched a lot of speculators totally misuse leverage and really hurt themselves. What do you see as the difference between the two?
That's a really good question. It really, for me, I first start with intention. What is it that I wish to do? The guys who are following the herd and they say, I just want to make money, they're going to lose the money. The guys who know why they're doing it, understand the rules of the game, and practices the principles don't change.
Yeah.
You put $1 in, you want $1 back in terms of interest and return. If you're going to try to think you're smarter than everyone else, you're going to lose. It's just that simple. Understand the fundamentals, be willing to go a little bit above that, but be careful, especially in this market.
Oh, math. The math should compel you to buy the deal. If the sales pitch is what's compelling you to buy the deal, then just turn off the sales pitch and get out a spreadsheet. And the spreadsheet will tell you whether you should buy a property or not.
Yeah. For everyone watching this, learn from that. You've provided several fundamental sheets to go through. I remember being in one of the classes where you talked about IRR, cap rates, all that. Every investor needs to know that. And if someone's offering you a 10% cap rate right now, meaning a return on your investment, and the marketplace is offering 6%, why are they offering you 10%? How are you going to be? Got to step back and say, am I that much smarter or that much luckier than everyone else in the world?
Yeah.
The world, go on.
Well, it's the 4 questions that you ask. First of all, how much capital do I have to employ? How much capital am I putting to work here? What's I call it your desired minimum rate of return. I will not take this money out of the bank unless it is X. And then, what is my risk tolerance? And then when do I need this money back? And those are the 4 basic questions for investors. And I can't tell you how many don't have that model to their capital there. I was taught to me by one of my mentors. He learned over the years that there's 4 types. There's investors. That's that guy. Put $1 out. I need $1 back. There's traders. They're flipping. They're just, working off arbitrage, essentially, of the price. Then there's players. They don't really have a system. They're just wheeling and dealing, trying to make money. Without a system, you tend to overstep your boundaries. And then there's the play us. You're never really, they're just really excited about it, but they're not. And a lot of them just don't have the they don't have the ability to dial into the players, to dial in, to focus on how to become even just a player and start doing business.
I have
And
to
it's
add one
really
more
down
thing
to
on
the
that. I want to add one more thing for your investors. Have an exit strategy. There's not a lender that I deal with that doesn't say, how am I going to be paid back? As an investor, how am I going to be taken out of this deal? Best case, middle case, worst case. If we have another recession, how am I going to sell this property and at least get some of my principal back? That's a predominant for me. I may not get all the profits, but make sure I get my principal back.
Yeah, without the return of the investment, there's no return on investment.
That's exactly right. That's exactly right.
So, John, if somebody needs to get a hold of you, needs to talk about getting funding for a deal, how would they get in touch with you? There's also going to be links to John in wherever you're watching this video, but how would they get in touch with you, John?
Two ways, 239-631-0033. 239-631-0033, or John, John, at Svirsky, SVIRSKY.com. And my website is SVIRSKY.com.
Cool. I enjoyed this, John. Look forward to seeing you in a meeting.
Thank you again. Bye now.